Welcome back to Business Accounting, Lesson 4. And during this lesson, we will look at the fundamental aspects of cost accounting and then certain terminology that we will use in cost accounting. Now, this lesson consists of a lot of definitions. You can now decide to study these definitions or try to understand them. It's always better if you understand the definitions because it's only then that you can apply the definitions. Now, the first one is the difference between cost and expense. Now, normally in everyday life, people will talk about cost and some people will talk about an expense. But in cost accounting, there's a difference. So cost refers to the amount spent by the business to acquire an asset or to create an asset. So that is the cost of the asset, whether you buy the asset or you create an asset. And expense is the ongoing operations of the business. So what we did last semester, we had rent expense, telephone expenses, and all of those. Those were expenses because that was not a cost to acquire an asset or to create an asset. So when we are with cost accounting and we are talking about assets that we will produce or buy, we have a cost. When we look at rent, stationery, telephone expenses, those are expenses. The next one is a cost object, and this is really an item that you can allocate cost to. So if we look at this cup of coffee, this is a cost object because we can say there's certain costs that we can relate or allocate to this cup of coffee. We will, for instance, have coffee, the coffee powder. We will have water. We will have cream or milk. We will have sugar, the cup and the lid, and then maybe the salary of the person who makes the coffee. So all these costs can directly be linked to the cost object. A responsibility center is a center where you normally have a manager, and that manager will be responsible for the performance of the center. So we have different responsibility centers. You can now look at NUST. We have student services, we have faculties, we have this. We have the faculty officer, so we have the registrar, we even have a clinic, a health clinic. Those are all responsibility centers. So let's quickly look at these ones. Cost center. So this manager is responsible. He will be held responsible for the costs. A revenue center. This manager will be accountable for the revenue generated by the center. Profit center. He will be is accountable for the profit of the center. And then investment, how will you measure this? How will you measure this person according to the investments and the return on investments? So in a responsibility center, you will have a certain person and he's accountable for that center. Now, an opportunity cost is the potential benefit that you give up when you choose one item. So let's look at an example. If you spend time and money and go watch a movie, now you cannot spend that time to read a book and you cannot spend the money on something else because you chose to spend your time and money on the movie. Let's say you decided to spend that time and money, that time on a book, then you cannot go to the movies because you had a choice. So when you have certain choices, the benefit that you will give up, the choice that you will give up, that one is called the opportunity cost. If we look at a business, they have 100,000 available. If they choose to produce a new product, then they cannot invest the money. So the opportunity cost will be the interest that they could get on this investment. A sunk cost, Those are costs. Remember, we are not talking about expenses, we are talking about costs which have already been incurred. So we already incurred those costs and which are unrecoverable. This cost should be ignored as it is irrelevant for future decisions. And advertising, if you already advertise the business, these are costs that you already incurred. So whether you produce new items or not, the advertising cost will stay there. The same with certain labor costs and the same with rent. You are renting this premises, whether you are going to develop the new product or not, you will still have to pay that rent. So this is a sunk cost and you will have to ignore that in your future decisions because you can't do anything about these costs. Now we look at avoidable versus unavoidable cost, and the name is telling you what it is. Avoidable, you can avoid these costs. If you are not going to produce this item, you won't have that direct material, you won't have the direct labor. Let's say you want to produce a new car, build a new car. Avoidable cost could be the material, the labor, the marketing of the car. Because if you are not going to build this car, you won't have that direct materials. Unavoidable cost, these are costs that will stay there. Whether you do this activity or not, whether you discontinue this activity or not, these costs will stay there. It can be rent again, it can be some salaries or some fixed costs. Now this is only to show you types of costs. We have a fixed cost. They are fixed and does not depend on the level of production. So let's say we decide to bake pancakes. And we rent a small kitchen to bake these pancakes. Whether we bake 10 pancakes or 50 pancakes, we still have to pay the rent. So the fixed cost will not differ according to the levels of production. Then a variable cost, it's a cost that change as production levels change. So if we look at the pancakes, the ingredients will definitely change. If we make 10 pancakes, we will need 1 cup of flour. If we make 20 pancakes, we will need 2 cups of flour. So the variable costs are the costs that change as your production levels changes. Then your semi-variable cost, also known as semi-fixed or mixed cost, because they have a component of a fixed cost and a variable cost. My manufacturing cost consists of my direct material, my direct labor, and my manufacturing overheads. Manufacturing overheads is usually your indirect cost and your indirect labor. Okay, so direct material, if we go back to the pancake, it will be my ingredients. A direct labor, if we go back to the pancakes, it's the person that bakes the pancake, because that is directly linked to the pancakes. Manufacturing overheads then, all the costs excluding the direct material and direct labor. So that is then your indirect labor and your indirect material. Indirect cost then, indirect material is the secondary material which may or may not form part of the finished product. So when we manufacture or build a table, we will have the wood, we will have some glue or nails. Now those are the indirect material. Indirect labor is the cost of labor that's not directly linked to this product. An example of fixed and variable cost, let's quickly look at KFC. All of you are familiar with Kentucky Fried Chicken. All right, so what can be a variable cost? What can be a fixed cost? Your fixed cost will be the rent. Your insurances, licenses, these are only examples. Because whether you sell 10 pieces of chicken or 100 pieces of chicken, these costs will remain the same. Your variable cost will changes with production. So if you make 10 pieces of chicken or 100 pieces of chicken, the food, the ingredients will change. Your packing material will change, your hourly wages will change, and also your electricity, because you need electricity to cook or to bake this chicken. Let's look at relevant versus irrelevant cost. Relevant costs are those costs relevant to the business decision. So if you decide to make lemonade from lemons, the cost of lemons will be a relevant cost. The cost of the stall where you are going to sell the lemonade is irrelevant, because you can sell Coke also at the stall. So the irrelevant cost will be the same for all the decisions. So whether you sell lemonade or Coke, the cost of this stall will stay the same, because those are the same for all decisions. Fixed overheads and sunk costs are examples, because they do not change with changes in decisions. Your differential or incremental cost, the difference in costs between two alternatives. Okay, so just to give you an example, if you opt to produce items, now you have two options. You can either use a fully automated process, which will cost you 100, or you can use manual labor, and that will cost you 80. So the incremental or the differential cost is then the difference, which is 20,000. Controllable versus uncontrollable cost. When cost can be changed according to the need of the product, they are controllable, because you can control the cost. If they cannot be changed or modified, they are uncontrollable. So if you have a restaurant, the food in the restaurant, the cost of the food is controllable, because you can control the cost of the food. But you cannot control the rent of the place maybe, or the advertising of the restaurant chain. Those are uncontrollable costs. There's also a few examples. Controllable will be your food, your labor and cleaning, but non-controllable or uncontrollable will be your insurance, your mortgage payments. These are interest if you have a loan, or your licenses. Those will still be there. You can't control these, but you can control the prices of the controllable costs, like your food and labor. And this is then the end of lesson 4. Our next lesson will also deals with definitions. Before we can go to the actual calculations of cost accounting, we must understand the definitions. So if people are talking about a fixed cost, you must know what is meant by fixed cost. You must know what is meant by a sunk cost. You must know the difference between expenses and costs. So these are really, it's really important that you understand these definitions for going forward in cost accounting then.